Hello and welcome to the Retirement Playbook, brought to you by Alspaugh Wealth Management. As always, I'm joined here by Mr. Tony Shore. Hello, Tony. How are you doing, bud?
Brock the Rock Alspaugh,
Oh,
the
boy.
Alspark, as
He's
I
had a
like to
lot of
call
coffee
him.
today, folks.
Yeah, drinking the caffeine, got some Coke Zero now, finished my 40 cups of coffee. But seriously, great to be here. Brock, thanks for having me on the show.
Absolutely.
You're the man, the myth, the legend.
Oh, boy.
Heard you.
You really need to calm down on that coffee.
I heard you talking on the radio this week about a market recap. That's
Yep.
awesome. Kind of the
Yep.
mid-year market recap, right?
And we are there, Tony.
Yeah.
We're there. So, yeah, we're going to talk a little bit about that and a lot more here on today's episode of the Retirement Playbook, brought to you by, again, Alspaugh Wealth Management. We are the retirement people. So if you need help in your life, if you're sitting here listening to my radio show or watching us or listening to the spots and you go, man, I probably ought to go see him, but just keep putting it off because you're busy and you got things to do, whatever. Hey, listen. Now is the time. Give us a call or just look us up on our website. You can request a consultation. We can even talk over the phone. It doesn't have to be a face-to-face meeting, and just talk about what's going on in your life and how we could potentially help you. Give us a call at 573-332-7855. Or again, that website is Alspaugh Wealth Management, all spelled out.com. Okay? All right, Tony, before we get into the market recap, and we're going to talk more about taxes. Last week we talked about taxes, and we want to continue that conversation because we all know that the 2017 Jobs and Tax Code Act these rates are going to expire at the end of next year. What are you going to do now to help yourself in the future? We're going to give you some tips on that. But before we get into the market recap, I also want to tell people about our website, Alspaugh Wealth Management, how it can help you if you need more information on, say, Roth conversions, if you need more information about the color of money and how the color of money risk analysis can help you, go to our website. It's alspaughwealthmanagement.com, and you can download past shows. You can request a copy of my book. You can buy a copy, actually. There's a link on there. So there's lots of things you can do on our website. It's a very useful website. It's not just information. There's things that you can use and put into place in your life. So check out that website, Alspaugh Wealth Management. All right, Tony. So we've had the first half of the year, and I have a question for you.
Okay.
Does this year, in life in general, not financials necessarily, feel a lot like last year in some ways?
Yeah. In fact, as I get older, it's harder and harder to distinguish, but especially, In fact, this year feels like 4 years ago for some reason. Like I've had deja vu.
Yes.
It's like it's a presidential election year. It's Trump versus Biden.
Oh, boy.
Wow, what's going on? Yeah. It's like, Are we stuck in, is it Groundhog's Day where we're stuck in a time loop or something like Bill Murray? Is that what's going on
That
here?
is a great movie, by the way. So
Rise and shine, it's Groundhog's Day.
That is a great movie. Listen, and the reason I ask you that question, Tony, is because there is a lot of similarity in the performance of the stock market this year with last year. And the reason I say that is because think about the big news. Think about the news and think about how it relates to the financial markets. And that is what? AI, artificial intelligence, right? That's a huge topic, and how it's evolving and how, it's helping company like NVIDIA, and the stock price is just going out, crazy. And so here's what I was relating to. The NASDAQ, which is mainly comprised of technology companies, okay, had a awesome year last year, up 30, actually more than 30%, okay, last year. And then the second best for the United States stock markets anyway was the S&P 500, up about 20. And then you had the Dow Jones, okay, and it was up about 9%, okay. So that was kind of the latter. Well, guess what, Tony? It's the exact same story this year. The NASDAQ is up 23, the S&P is up 15, and the Dow Jones is up 4. So why is that important? Well, it's important because it goes to the premise and the fundamentals of investing, which is called what? Diversification.
Yes.
Okay. Because if you were all invested in value stocks because you like the dividend, and who doesn't like a good dividend now and then, right? It's like a pizza. It's
Yeah.
like a pizza. You love
Everybody
the
loves
dividend.
it.
It's money coming in, right? And you're reinvesting those dividends. But the point is, you might love those stocks, but if all of your money was invested in value stocks or like stocks from the Dow Jones, you are way behind the average of a nice diversified portfolio, number one. But then number two, you're way behind the S&P 500, and you're really way behind the NASDAQ and technology companies. So again, going back to make sure. Now, that's the first point I wanted to make. The second point of this is to make sure that you are balanced. When there are certain investments in your portfolio, like, again, those technology companies, Apple, Microsoft, NVIDIA. By the way, those three companies are all worth now $3 trillion each. Okay? $3 trillion. Like, I get it. You probably can't even comprehend $1 trillion, right? Because it's
more than a lot of small countries in the world. Yeah.
And so the whole S&P 500 different companies, Tony, is 44 trillion. Okay? So what does that mean? That means that those three companies alone make up more than 20% of the index. Three companies out of 500 is 20% of the index.
That's crazy.
Be careful.
Yeah, be very careful. Yeah.
Okay? It's like this is the example I give a lot of times when you're looking at your 401k investment lineup. And what do you do when you choose those funds? You look at past performance. And that's okay for long-term, 10-year performance maybe, because it shows you the consistency of that particular fund. But if you're looking at just the 1 and 2 year rates of returns and you're going, I'm going to put my money in that, be very careful.
Yes.
Be very careful. I would suggest that people look at their current portfolio, and if it's not being automatically rebalanced, that you go in and rebalance your funds, because those technology stocks that were supposed to be 10% of your overall are now maybe 15% or 20%. So you've got to rebalance that to make sure that if the market does go down, you can weather that storm a little bit better. Okay? So again, two kind of fold there's. One is we're on a trajectory just like last year with the stock market and the different, types of indices. And then two, hey, do something about it. Because the information that we give you folks, this is to help you. This is to help you in your life. This isn't just like, oh, hey, Brock's on here and he's trying to promote his business or whatever. No, this is to give you information to help yourself.
Right.
Okay? And then if you need additional help and something further, then yes, we're here to help folks. But anyway, the point is do something about it, rebalance, make sure that I like to see people do annual rebalance, Tony, because I feel like that gives your winners time to win. But at the same time, with markets being at all-time high, by the way, this week, S&P 500 and NASDAQ both closed at a record close. It's the highest it's ever been.
Yep.
Okay. So what are we doing to make sure that if the market does go down and volatility is ahead, and my personal opinion, volatility is coming. Okay. And I'm not saying
a correction. Anytime you hit these record highs, there's going to be a correction.
You got to understand that corrections are part of investing.
Right.
Okay.
You can't panic. You can't get excited every time they hit a record high and start buying those stocks that are up there and put all your money in NVIDIA when it's at a record high. And you can't panic when everything starts coming down and sell. If you keep doing that, you're going to end up buying high and selling low every time, right?
Think about it like this. Okay, NVIDIA is up 150% this year.
Ridiculous. Yeah.
This year, Tony, it's up 200% over the last year, almost. So it's just, look, let's take some money off the table. Let's rebalance this thing. And I'm not saying sell everything and put it in cash. No, don't do that.
No.
Okay, just rebalance your portfolio and make sure that your contributions that are going into your portfolio are balanced as well. And then, the last thing I'll say about, the first half of this year is that, interestingly, Tony, if you look at and beyond just those three indices, because a lot of that is those are bigger companies, right? The Dow Jones is 30 companies, the S&P is the top 500. The NASDAQ has got these huge technology companies, so that's all mainly large. But if you look at something that you probably haven't looked at or heard about too much is the Russell 2000, folks.
Yeah, the Russell.
Yeah, Russell 2000 is small cap stocks. And guess what? It's only up 1.6% year to date. Okay. That might be something to look at. Okay. That's contrarian, right? Because everybody else wants to invest in these bigger companies that have gone crazy. Small cap companies should be a part of your diversified portfolio. Make sure that just because it hasn't performed well, look, that's when you want to get in. Okay.
Yeah.
And again, I'm not telling you to go put all your money in small cap. You need to be balanced and you need to be diversified. But I'm just telling you, man, I like that IWM, that Russell 2000 right now. And I get it. The reason why these companies are not up as much is because why? When interest rates are up, a lot of these companies have to borrow money for operations because they're so small. And so when rates go up, that takes away from profitability. Okay. I think rates are going to start coming down and the consumer is still strong. Okay. If the consumer is strong, that helps small caps as well. So, it's maybe a contrarian kind of thing, but man, I'm telling you, I like it.
Yeah, so, and here's the bottom line here. I just want to note this really quick before we move on to taxes and withdrawals in retirement, which is what we're going to talk about next. I know you want to talk about that, but we're not giving specific investment advice to individuals on the show. We don't do that. And what you're saying is everybody's situation is different. And so before you recommend specific things, you're going to want to meet with them and say, okay, where are you at? Where are your goals? Okay, here's what would work best for your situation, right?
100%.
You're not making blanket recommendations on the show. And I just wanted, I know you're not, but I wanted to point that out and remind everybody,
that's a good reminder. And I appreciate
that you need to meet with a financial professional. I'm not going to name names, Brock Alspaugh, but I know a guy you could meet with and get a plan in place and have them review your portfolio. Don't do this DIY stuff. Because there is a lot to know. A lot of people doing DIY probably would have, did you know that the Russell 2000 was an option? Have you even considered it?
Right.
And that's the point you're trying to make, is to be truly diversified, you need to work with a financial professional who's going to look out for your best interest based on your personal situation. And Brock, I know that's what you're passionate about and you do for your clients. So
you got it right. So thank you for pointing that out, Tony. And so one last thing before we move on is I just want to point out that when it comes to the bond market, so it's not just stock market, right?
Right.
The bond market, the 2-year treasury is still paying more than the 10 years. In fact, 4.72 on the 2-year and 4.37 on the 10-year.
So it's still inverted, and it probably will be until interest rates come down and inflation.
Right. Yeah,
I don't know.
Yeah, it's who knows, but it's unbelievable how long it has stayed there, and yet the stock market is still up. It's really baffling because usually in the past, the inverted yield curves, it's a predictor for
a major recession.
Yeah, so it's like, okay, I don't know. Here we go. So, all right, Tony, that pretty much covers the update. One last thing, actually, the 30-year mortgage is still over 7%. So, you can see why the housing market is definitely slowed down. In fact, the real estate index is it's actually down on the year 2.5%. So that's why, right?
Some of that's intentional by the Fed to try to slow inflation. Yeah, and that's what's happening. Those high interest rates are slowing down inflation, right?
Yeah, absolutely. It's working, right?
Yeah.
I just wish they would have acted before when they kept saying it was transitory, but
not great for the housing market though right now.
No, it's not. Not. All right, let's get on to that tax conversation. Last week we talked a lot about the state tax exemption and how that's going to be affected. We talked about child tax credit and how that's going to be affected. We've talked a lot about the different aspects and what is going to be affected and what you could do about it from the expiration of the 2017 Jobs and Tax Cut Act. Okay, so we're going to continue that conversation here today. And the first piece of your strategy to help with all of these things, with tax rates going up, which means you're going to have to pay, higher taxes on IRA withdrawals because those are taxed at ordinary income. We don't know what's going to happen with capital gains tax yet on non-qualified money. So, to be continued on that discussion as well. But the first piece of your strategy should be ensuring that you avoid early withdrawal penalties, Tony. If you begin taking money out of your traditional 401k or IRA before you reach 59 and a half, I know it's a silly age, 59 and a half. What's that all about? Whatever.
We don't count half years after the age of 5, Brock.
But the point is that early withdrawal penalty is 10%, Tony. So people ask me all the time, well, I don't think I'm going to take money out of my 401k or my IRA to pay for this boat or lake house or whatever. And, I'll put the money back in later. Well, guess what? That's a horrible idea, because you not only have to pay taxes on the money that you take out of that traditional IRA, but you've got this 10% early withdrawal penalty. And so now let's just say you're in the average effective rate is 20. So you're going to pay 30%, 10% in penalties and 20% in taxes. You're going to pay 30% to the government. So you're only going to get 70%, right? And then, you putting money back in. How about the power of compounding? You've lost it now with those dollars that were in there.
Right.
Okay. So it's a significant hit by taking money out of your plan prior to you being 59 and a half. Now, having said that, there are some things, if you are got a true good plan here, and we're going to use this money to live off of because you want to retire a little earlier, there are some things you can do. 72T, okay? 72T is an exemption within the IRS code that allows you to take money out prior to 59 and a half, but you've got to set it up correctly. And you have to be very regimented with this, Tony, because if you break the rules, then you're going to be subject to taxes and penalties. So you've got to make sure that, yes, you can retire before 59 and a half, folks.
Sure.
If you've amassed enough money and your lifestyle suggests that, you can have enough income from your investments to get you through and not two, but just to and through Social Security income, by all means, do it. And you can exercise things like 72T. You can also do, if you have company stock in your 401k, you can do what we call net unrealized appreciation to help you out with taxes there. So there are some things you can do, folks. There's planning to be done if you want to retire before 59 and a half. But a plan to just take money out, pay taxes, and pay a penalty is not a plan. That's just an action that's just a lot of times not a good one.
Yeah.
I'm just being honest.
Right. And you have to consider the tax implications when you're taking these withdrawals. And again, you want to avoid penalties, because not only do you have to pay the penalty, but you have to pay the taxes on top of that still.
Exactly.
So it's 10% on top of whatever taxes you owe. So you want to avoid that.
Exactly.
And know the rules. Like 401ks have some different withdrawal rules than traditional IRAs, don't they?
They do. And so, and by the way, Tony, too, every plan document, so you definitely have, general ERISA rules that you have to follow, obviously, but you also have to follow the rules of the plan itself. When you have a 401k plan, they have provisions in there. Like sometimes you have a loan provision. Sometimes you don't. Sometimes you've got a hardship withdrawal provision. Sometimes you don't. It all depends on the elections that your employer have made when they set up that plan, or any provisions that they modified during, the time they've had it. So again, just knowing all of the ERISA rules, but then also knowing your plan rules is something you definitely need to know about. All right, Tony, let's move on to required minimum distributions.
Ooh, RMDs. I like RMDs. Really massive donuts is what I thought it stood for. But it's required minimum distribution, unfortunately. Yeah.
Okay. What's funny about this? We talk about food quite a bit.
Yeah.
I love food.
Yeah.
I know you do too. And so, but we don't talk about donuts very much. That's kind of the first time.
We don't talk about what?
Donuts. That was the first time I've heard you talk about donuts.
Yeah. Donuts. I mean, I don't want to turn into Homer Simpson character on the show, right? But donuts.
There you go. Yeah. There's your reference of the Simpsons. Here we go. Show's going downhill, folks. Anyway,
it is not going downhill. That's not true. That's not true.
All right. So listen, folks, when you turn 73, as of right now, and this age is going up, and we'll talk about that, you have to take a distribution from your IRA. The government has basically said, look, you've deferred this money long enough, so now it's time to withdraw some of that money so we can collect tax dollars on this because, again, it's taxed at ordinary income,
Yep.
right? So when you turn 73, and thank goodness they changed this, Tony. It used to be 70 and a half. Okay. Like, what is up with all
Again,
these half ages? I don't get
yeah,
it. But
I don't
they
know
did.
why it was 70 and a half. That's
Well, the
crazy.
Secure Act moved it to 72. Secure Act 2.0 moved it to 73. And then, if you're younger, it could be up to 75. So, that is a good thing. Now, people are maybe listening or watching and going, well, why does this matter? Because I've saved this money and I'm going to take this money out and live off of it. Well, okay, great. That's what you should do or could do. But some people have enough income through Social Security, pensions, and maybe some other dollars that they just don't really want to pay taxes on the money, so they don't take it out. But at this age, again, you have to. If you
Right.
don't take it out, there is a penalty. We're talking a lot about penalties today. RMD penalty used to be 50%, and now it's 25%. So if you should have taken out $10,000 and you did not, that's a $2,500 penalty. Okay, this is a penalty, folks. So make sure that when you reach these ages, that you take these distributions out, right? Because at 73, it's the year you turn 73. Okay, so by December 31st, you have to have had this money out of your IRA. Okay, the required minimum. You can obviously take more. Okay, this is just a minimum that the government makes you take out. It's not a percentage, by the way. A lot of people think it's a percentage. There's a formula, and you add up all of your IRAs. Okay, and you
Right.
divide by a divisor based on how old you are. So, so for example, if you are 73 and you have to add up all of the dollars in all of your IRAs and divide by, I believe it's around 24. Okay, so you divide it by 24, and that's how much you have to take out. Okay, that divisor then goes down every year, Tony, which means what? That means you have to take out more money. And then, of course, the change in your balance reflects on that too, because it's based on the balance from the year before. 12/31 balance from the year before. So if I'm turning 73, let's say September, I've got to take my required minimum by December 31st, but it's going to be based off of the balances of 12/31 of 23. Okay. Does that make sense? And then the other aspect of this is that, and this is kind of coming down to a planning piece as well, is that you don't have to take the dollars proportionally from each IRA that you have. Okay. You can take it out of a little bit out of all of them. You can take the entire amount out of one of them, or of any combination. The government doesn't care. They just say, look, this is the total amount of pre-tax money you have invested in IRAs, traditional IRAs. And then when you become required minimum date age, then you have to take out a withdrawal based on the total balance, and they don't care where it comes from. Okay.
Yep.
So that might be something too, is that if you know you have to take out this distribution, maybe let's take it out of an account that's not affected by the fluctuation in the stock market. Right. So that's a strategy that we've put into place for some of our clients. So,
Sure.
What's really cool though, Tony, if you have a Roth IRA, don't have to take it out. No RMDs.
Yeah. And no
Big-
taxes, period.
And no taxes, period. Now, if you die and you're over the required minimum date age, then, of course, your beneficiaries still do have to take a required minimum, but it's tax free, right?
Yeah.
And it still has to be gone within 10 years, but it's tax free.
Yeah.
So it's like the advantage. People go, well, why would I stretch it over 10 years? Because it continues to grow tax free. That's why you would do it.
Yeah. Yeah. You want to leave it in there to grow as long as you can, tax free, unless you absolutely have to have the money.
That's right, Tony. And here's another thing, that misconception. People think that, okay, my parents died. I inherited their IRA. So now I have established a beneficiary IRA. You cannot roll that into your own IRA or Roth IRA. Okay. That is a big misconception that is out there. You cannot do that.
So you can't roll an inherited IRA into your own.
That's correct. And there's different rules for the required minimum taking out of that account too. So it's a different, remember I talked about that divisor? It's a different divisor. So don't commingle these funds. If you have a beneficiary IRA because you inherited an IRA from your parents, leave it in a beneficiary IRA, because this is separate rules, and it's got to be gone in 10 years. Okay.
But what if I take the money out of the inherited IRA?
Right.
and then put it in my bank account,
Mm-hmm.
and then I put it into my own
Sure.
IRA.
Sure. If you've got enough, income to offset that contribution, you can't exceed.
Oh, but you have to have income. So the trick is if you're retired, you're not going to have
Correct.
income probably to.
That's correct.
Obviously. Yeah.
Because you have to have earned income to offset a contribution.
Earned income, which most people don't have in
retirement. Right.
Yeah.
So they might have income, but it's not earned income.
But if I'm working and have earned income, then I can
do that.
But I wouldn't do any of this. This is way more, even the RMDs and Roth IRAs and conversions and rollovers. You'd be crazy not to work with someone like yourself and get your help with this, right? I mean, you can make very costly mistakes.
So I write an article for the Southeast Missouri. It's our local paper here, and I'm writing my last one. I'm kind of I'm done with it. I'm not going to do it anymore. Once a month, and I say that specifically in the article. Like, my biggest piece of advice that I can give people is work with a professional.
Yeah.
Get over whatever preconceived notions you have or thoughts that you have about the experience or what it's going to cost or whatever. Get over it.
Yeah.
Go talk to somebody. It doesn't cost money to go talk to a professional.
No.
So just go talk
You
to
offer
them.
no charge, no obligation consultations. There's no charge. You don't charge people for the initial couple consultations, and you can at least figure out where you're at. And then if you want to continue working with that professional, if they're a good professional, they'll be very transparent and open about how do you make money and what am I going to be paying you? And you're very transparent about that.
100%.
And I think people would be surprised versus what they're already paying within their accounts for fees that they don't even realize. And
I don't think
how it matches up.
I don't think it's always about money either, Tony. I think people are just intimidated. They don't think they have enough money.
Yeah.
They don't, whatever the reason may be, get over it and go get professional help when it comes to your finances, because quite frankly, this is your financial viability for the rest of your life. It's not just about now and what you're doing. Where are you going and how are you going to get there?
Yeah.
We can help do that. Give us a call or go to our website. It's alspaughwealthmanagement.com. Get started today.
All right. Well, Brock, great show today. Awesome stuff. We covered the mid-year recap for the markets. We covered taxes on withdrawals in retirement. We covered Roth. So great show. And once more, before we go, let our listeners know how they can get a hold of you.
Yeah, give us a good old-fashioned phone call, folks. It's 573-332-7855. Or, again, that website is www.alspaugh, ALSPAUGH, wealthmanagement.com.
All right. Thanks, Brock. And that does it for today's episode of the Retirement Playbook with our host, Brock Alspaugh. Thanks, man. Good show.
Yeah, good job, dude.